think there are a number of factors as to why we are heading into a global low return environment. I think the first is that since the crisis of 2008 and 2009, central banks in developed economies around the world have dropped interest rates to very low levels, record low levels in many instances. And what that has caused investment professionals and the investment community to do is to reprice assets assuming this lower interest rate, lower for longer interest rate environment. Essentially the discount rate that people are using for future cash flows has reduced. And the discount rate is really the return that investors are getting at that price. So lower interest rates have really fed through to higher prices initially, but that means from here on returns are likely to be a lot lower. I think the second point is that if interest rates do stay lower for longer, we do have a scenario where companies actually recalibrate their return expectations. So CFOs, CEOs and boards at companies around the world, instead of looking for 10, 11, 12% return on capital, they look at their borrowing costs and say, you know what, maybe we can start justifying more projects at lower returns. And lower returns on capital feed through to lower returns in share prices. And the third point is that and this is not an Australian experience, this is a global experience. There is a lot of capital in the world looking for a return, looking for returns in line with what they've done previously. And excess capital around the world seeking a relatively static opportunity set. Economies haven't been growing that quickly, but the amount of capital looking for return has been growing quite quickly. So as a result, return on capital is another driver for return on capital to fall over time, which we believe will feed through into lower share price returns. Australia is not immune to these dynamics. We currently have a cash interest rate of 2%, which is high in relative context, but it's a historic low in Australian context. So the same dynamics really are playing out here in Australia. We also have a legislated superannuation scheme where superannuation assets are constantly growing. In fact, over the last 4 to 5 years, the growth in assets under management, which now exceeds over $2 trillion, the growth in assets under management is exceeding the growth in corporate profits. And at the end of the day, if capital's only claim is on corporate profits, and if capital's growing faster, then return on capital will also fall. We have a poster child for this particular dynamic around the world. It's Japan. The data we've looked at since the 1960s shows return on capital in Japan has declined significantly from around 8% to 3% over the last 50 years, and that has coincided with progressively lower interest rates that we've seen in Japan. So I think the rest of the world can learn a little bit from that low interest rates might be good in the short term for share prices, but in the long term it does mean lower return on capital and lower returns for shareholders. And Australia really isn't immune to that dynamic. I think for global real estate, the risk to global real estate is sustained low interest rates. And that might sound a little counterintuitive because I think a lot of people think low interest rates is good for real estate. And again, it is in the short term, but what essentially happens is that investors in a search for return or a search for yield end up becoming very aggressive when they buy real estate assets, and they push yields lower and lower and lower. And what happens in reality is that asset prices obviously rise. They rise to a point where prices start to reflect a potential economic profit for developers to supply the market with new stock. And we're starting to see that certainly in Australia. Anyone who looks at the dwelling approval numbers in Australia, which are currently at record highs, show that there's a lot of supply coming through in the Australian residential market and also in the commercial market as well. And that's a symptom of having very low interest rates. It's a symptom of having a lot of capital. But we're also seeing it offshore as well, not to as large an extent, but certainly in commercial markets in the UK and the US, we are starting to see some supply coming through. And that is a function of low interest rates and capital looking to be put to work and generate a return. What we try to do at Quay is, being aware of this dynamic, we tried to differentiate real estate into two buckets, if you like. The first bucket is what we call franchise real estate. So a good example of that would be a fortress-style shopping centre, a regional shopping centre. So Chadstone in Melbourne is a good example, or Westfield Bondi Junction is a good example in Australia. These assets are very hard to replicate, so it really doesn't matter how much capital there is in the system. No one's really going to build another Chadstone again, or no one's really going to build another Westfield Bondi because there are physical and economic barriers to entry. So these are terrific assets to own in this sort of environment because you are well protected from a capital perspective. The other bucket we think about is the more commodity style real estate. So that includes maybe office towers, apartments, industrial property. Assets that are easily substitutable. Tenants could move from one office building to another and it really doesn't affect their business too much. Commodity style real estate is easily reproduced, and what we try to do there is we try to identify assets where we believe we're buying below replacement cost. Because if we keep buying assets below replacement cost, it really doesn't matter how much capital's in the system. New supply is going to be delivered at a price point higher than our investment, and therefore we're fine with that because it means that we'll be generating acceptable returns. And that's really the process that we try to adopt.